Yo, it's locked and loaded, grinding for commission. Clients getting funded, that's Nick and Anthony's vision. Tune in, real talk, no clone, we on it. It's the vibe, it's the grind, it's locked and loaded.
When having the conversation variable fixed, some clients want to, set it and forget it. Meaning, you know what, rates are still at a pretty affordable mark right now. So people will be comfortable with it for a 3 or 5 year time. So I mean, that's kind of how I look at it.
Yeah. I mean, from a risk perspective, obviously there's always a little bit more risk in terms of a variable just because of the fluctuation. But given the current market, it does look like there's a downward trend. So it is, a product I would heavily discuss and just make sure that the clients definitely know their options, especially during this time.
Yeah, I mean, one other thing I just want to piggyback off what Anth was saying, like right now we're in a downward trend as it pertains to interest rates. So yes, clients are reaping the benefits of it, but both of us having been through the opposite where rates were low and then started to rapidly increase. That's important to have that conversation with clients too, because yes, while things are on the decline now, to Ant's point, we need to let clients know the risk if rates were to go the other way and how that's going to impact their payments, potentially cash flows, those types of things there.
Yeah, so I mean, obviously, given the time, the rates were extremely low. I'd say the biggest thing people are coming back to us with are the payments. I mean, the payments have almost doubled in most cases. So it's been a little bit stressful for most people. Oftentimes, people are looking to kind of refinance and reset, get themselves back to the original amortization, which will help bring that payment down. I'd say that's probably been the biggest hurdle that we'd have to kind of jump over. Just because obviously rates were at such an all-time low, which generated such low payments, and then to see them, spike to almost a double what they were, definitely it hurt a few people in the pockets there, right?
I'd say with that, the other thing I think Anthony does a good job of, I like to think I do a good job myself, is having that conversation with clients, be it from a cash flow perspective. If we are able to save you $400 a month now, great. We saved you $400 a month in terms of your payment, but what are you doing with that $400? It doesn't mean that you're going to go out and start spending it now. Are you setting up a savings plan? Are you doing those types of things to better you in case of these situations that come up in the market? I know Anthony does a good job. He's literally gone with his clients to an institution to open up savings accounts for clients so they can put that money away. So yes, mortgages is the primary, focus of our business, but it's also giving that advice. I'd say that's something, I don't know, that I think
Absolutely. I
think it's important for the clients.
We take a holistic approach, and obviously we're in the financial industry. So given that we also have a background in that industry as well, we like to kind of step on all the avenues and make sure people are given the best possible advice and have that best road for success. Listen, I think the media does a really poor job of getting everybody going, and I think they kind of really focus on the rates and then get everybody kind of talking. So I think Canadians are very rate driven. I feel like the market is very rate driven. You kind of see when people say, the rates are dropping, then all of a sudden you're gonna have a spike in the real estate market, and it tries to get everybody boiling over when you realistically should be kind of taking a step back, looking at what is their current rate, looking at what your affordability is, looking at what the homes are kind of being purchased for, or what they're selling for, whatever the case is. And I think it should always be what you can afford, not kind of what is the rates going to do, because you're going to have that mortgage for 25 to 30 years, and in some people's cases it's more. So to be stuck on what the rate is right now is a little bit silly. You should really take a holistic approach and kind of have a real budget, set yourself out and plan for that 25 to 30 year mark, not just the 1, 2, 3 short term approach, right? And I think that's where we kind of really get stuck, and where we kind of try to talk to that whole approach and give that holistic advice again. And I think that's where we kind of specialize in and try to take away from all the rate drama that really does go on here, right?
Yeah, just to build off of that, in terms of like rates, sometimes a couple things. One, the media does a good job of bad news sells. So rates are on the rise, it's doom and gloom, it's the end of the world. When rates are going down, yes, they talk about it, but I wouldn't say with the same amount of love. When it comes to like rates, sometimes we have the conversation with clients. Lenders obviously have different guidelines, different lending policies. Sometimes we can go to a client and say, hey, look, lender A is willing to give you $500,000 approval and the rate is X. But lender B is willing to give you 600,000 and the rate might be a touch higher. So what's more important to you? Is the rate more important than the availability of funds? Does us getting you more money put you in a better position long term? To Anthony's point, look at a big picture. Like, yes, rates are important, but one thing I always turn it around and ask a client, majority of people have car leases right now. Do you know what you're paying on your car lease? Clients look at you like a deer in headlights, right? They don't know. So yes, rate is super important, not shying away from that conversation, but it's not the end all be all when it comes to mortgage financing and lending, right?
I think the media is definitely the biggest factor because they've got the most viewers, I'd say. And so that kind of drives it, and then it gets people talking. So, if you hear something, now the next thing you know, you're out for lunch with 5 people, you're telling them what you heard. And that's, how it kind of spikes things up. So I kind of think that's what kind of drives it and kind of gets everybody going, in my opinion.
Yeah, I mean, I think it makes for good dinner talk too. Never want to come across as I'm giving advice or, chirping, but the best is, I was at dinner and my neighbor got XYZ as in terms of rate, right? Well, that's great. Well, how big is the mortgage? What are they banking with? There's so many factors that come into rates right now, especially when the banks are pricing it too. So it's not a mortgage agent broker, and I don't want to sound like being defensive here, but it is some lenders are relationship based. Some lenders are more, hey, if you're doing $1 million mortgage, yeah, I'm probably gonna give you a better rate if your mortgage is $130,000, right? So I think it's a mix of everything, really.
I don't think timing the market would be considered a strategy. I think there's definitely a little bit of luck of the draw.
Ask those guys who bought 16 pre-cons in 2022. How's it going?
It's a tough time.
Yeah.
So timing the market is, I'd say next to impossible. Sometimes you can find yourself in a sweet spot, where you're kind of watching, and if you have the ability, like if you're not a forced buyer, you don't need a home right now, or you don't need to sell right now, you can kind of say, okay, I'm going to watch the market and kind of see where trends are and maybe jump in or jump out at a specific time. But I think if you're just, on the sidelines waiting to get in, I think it's very, very tough to sit there and say, I want to time the market. I think you got to do what's right for you at the time, what you can afford, put yourself in the best position for success, and then, don't look back at it and say, oh, this is the decision I made and why did I do this? It's kind of good, after you make that decision, look forward and continue your plan and continue to execute the way you started out to do.
Yeah, I hate to keep going back to COVID as like one of those benchmarks, but COVID basically put the real estate market on steroids, when you're basically giving money away for free, everybody kind of was, a real estate investor, and all of a sudden they weren't buying one property, they were buying 3. Now, again, timing of it, yeah, they saw an opportunity, they took it. The people that got out, the people that held, if you have that conversation with them today, they're either selling at a loss because, as we mentioned earlier, rates have gone up and now their cash flows are at a position where they can't afford that property.
So on our side, I think we do a good job of, we don't sell a rate. We sell the product that I guess best suit your need. So when you're looking at it, yeah, rate is super important, but what else do you want to do? Like, for example, if you're talking about a variable rate, the variable rate is the lowest for whatever reason, but you're seeing, trends in the market, or you watch a fixed rate and you're looking at the bond yield as they're going a little bit crazy, whatever the case is. But what else do you need, right? On a variable rate, are you going to maybe sell your home in a year? So now you have an exit strategy. So whether it's lower or higher, right, you're not going to take a 5-year fixed because it's lower, but you're thinking about selling your home in 2 years. You're gonna wanna take a variable. It might be a little bit higher now, but you're only gonna pay 3 months interest. So we try to stay away from like selling the best rate and take a look at the whole picture. And sometimes the best rate is just, what that person needs because they're staying there and they don't care, whatever the case is. But we try to talk about the whole concept, right? We try to stay away from just the rate and see what you need, what's your plan, what are you gonna do? And then we kind of go from there. That's what I would say our approach would generally be.
Yeah, I'd say when it comes to rates, we're super transparent too. If, we have refinances are huge in 2025 and coming into 2026. A lot of people have their mortgages coming up for renewal. Now, if you're going to come and quote a number that your institution's offering you, and I know that I cannot come close to that rate, I'm going to tell you, hey, stay where you are. That's the best option for you. Because again, to Anthony's point, it's advice driven. But the same token, if you're planning on selling in 3 years and you're like, but I just want the lowest rate, why would I put you in a 5-year so you have a penalty down the road? So again, yes, rate is super important. I am a consumer, I have a mortgage. I put myself in their shoes, but it's not the end all be all, I think, of mortgages, lending options. Securing an approval, I'd say, is the number one thing because that's why the client's coming to you. Then from there, providing them options. So it's not, hey, Nick is telling you this, but hey, here's option 1, 2, and 3. I kind of go back to my days working at the bank. I never want to assume what the client needs. I want to say, hey, here are the 2 options for you, 3 options, because I never want them to come back and say, hey, Nick, why didn't you tell me about this option? Well, I didn't think you'd like it. Well, it was the right option for me. Whatever that might be, doing a reverse mortgage instead of doing a regular mortgage. So going over and saying, hey, Mr. or Mrs. Customer, here's option 1, 2, and 3, and then coming up with it. Obviously, like I said earlier, getting them approved, but getting them approved with options when possible. That's it.
Yeah. No, I definitely agree with that, and I definitely would piggyback a little bit as well. We make sure that the client, affordability is a big thing for us. So a lot of times people will walk into the office and just say, hey, what's my max?
Yeah.
And for me, that question drives me nuts because then I sit down and I say, here, let's talk about the max. Max that you can get approved and max that you can afford are 2 different pieces. So although on paper I might be able to get you this much money, let's take a look at what else do you have to pay for, right? Like you got a car loan, then you got to pay for food, you got to pay for gas. Do your kids go to school, private schools? Are your kids in daycare? Everybody forgets those other obligations when they're coming in to get a mortgage, and it's always about what's my max, right? So I kind of like to sit there, we run out a budget, and I will show you, yes, here's your max, this is what you're going to spend, here's the other money that you're going to spend, what do you have left with after your true earnings are shown on paper, right? So making them understand exactly what they can afford is kind of one of the biggest tasks that I think we have. And it's not always about what's the max mortgage and how much money can I go spend on this house. It's more what can I truly afford. And I think we both do a really good job at that. And I think that's where we kind of come in and help a lot of people really understand where they really belong, right?
Yeah, to that point, I think there's been like a number of times where having that conversation, be it a first-time buyer or repeat buyer, where it's like, well, what's the max? Well, you can afford a mortgage of 1.1 million. And then you tell them what the payments are, and they're like, well, I don't want to pay that much. So it's almost like saying, well, tell me, what are you comfortable paying monthly? And then they kind of give you that number, and then you kind of navigate them to, hey, this is probably your sweet spot, right? You don't have to, keep up with the Joneses and buy something for 1.6 million, Yeah, you can afford it, but based on what you're telling me, you like to travel, you like to do this, you like to do that, you're probably better off buying something in the 1.3 mark. So
one of the biggest misconceptions that people have are when fixed rates drop, they're assuming variable rates drop. Or when the Bank of Canada is making an announcement that the rate's dropping, fixed rates are going to go down. The two run on different train lines. So fixed rates are really based on the bond yield, whereas variable rates are attached to the Bank of Canada. So sometimes the two do run parallel, right? But oftentimes they do not. So, when someone comes in and say, hey, well, the Bank of Canada just made an announcement, what's your best 5-year fixed? Doesn't always necessarily mean that 5-year fixed has come down, right? So those are a couple things that a couple questions that we get very, very often, and my phone will blow up the day after the Bank of Canada makes an announcement. But the two are definitely on 2 different train lines. Again, sometimes they do run parallel, but for the most part, they're doing their own thing, right?